Welcome back to the channel. Today we're diving into the exciting world of trading. Whether you're a seasoned investor or just getting started, understanding the different types of trading can help you make better financial decisions. We'll be covering everything from stocks and Forex to crypto and commodities. I'll break down the basics of each market, discuss the potential risks and rewards, and give you some tips to get started. Remember, trading involves risk, and it's important to do your own research before investing any money. But with the right knowledge and approach, trading can be a powerful tool to grow your wealth. Let's get started. Let's start with the basics. Stocks. When you buy a stock, you're essentially buying a small piece of ownership in a publicly traded company. It's like buying a tiny slice of your favorite pizza place, except instead of getting free pizza, you get the potential for profits. Think of it this way. Companies need money to grow, right? Well, one way they raise capital is by issuing stocks. When you buy a stock, you're giving that company money in exchange for a share of their future earnings. If the company does well, its stock price goes up and your investment grows. On the flip side, if the company performs poorly, the stock price may drop and you could lose money. Now, you can't just walk into any old pizza place and buy a slice of the business. You need a special marketplace to buy and sell stocks, and that's where stock exchanges come in. Think of them like giant farmers markets, but instead of selling fruits and veggies, they're trading shares of companies like Apple, Tesla, or Amazon. Some of the biggest stock exchanges in the world include the New York Stock Exchange, the Nasdaq, and the London Stock Exchange. These exchanges provide a platform for buyers and sellers to connect and trade stocks throughout the day. But here's the thing about the stock market. It's not for the faint of heart. It can be incredibly volatile, with prices going up and down like a roller coaster. One minute your portfolio is soaring, the next it's plummeting faster than you can say margin call. That's why it's crucial to understand the risks involved before investing in stocks. Don't just dump your life savings into the latest meme stock because you saw it on Reddit. Do your research, diversify your portfolio, and invest for the long term. Remember, slow and steady wins the race, especially in the stock market. Speaking of research, you're going to want to understand a few key things before buying any stock. First up, earnings per share. That's the profit a company makes for each outstanding share of stock. A higher EPS generally indicates a more profitable company. Then there's the price-to-earnings ratio, or PE ratio. This metric compares a company's stock price to its earnings per share and can give you an idea of whether a stock is overvalued or undervalued. Of course, there's a whole lot more to learn about stock trading, but these are the fundamentals. We'll dive into more detail in future videos, so be sure to subscribe and hit the notification bell so you don't miss out. Now let's move on to the exciting world of Forex trading, or foreign exchange. It's the largest and most liquid financial market in the world, with trillions of dollars changing hands every single day. But what exactly is Forex and how does it work? Imagine you're planning a trip to Europe. You'll need to exchange your US dollars for euros, right? Well, that's essentially what Forex trading is all about, buying and selling currencies to profit from the fluctuations in exchange rates. In Forex, currencies are traded in pairs. For example, the Euro-US dollar pair, EUR-USD, is one of the most popular. If you think the euro is going to strengthen against the US dollar, you would buy the EUR-USD pair. If you believe the euro will weaken, you would sell the pair. But what causes these exchange rates to fluctuate in the first place? Well, it all comes down to supply and demand, just like any other market. A country's economic performance, interest rates, political stability, and even natural disasters can all impact the value of its currency. Let's say the US economy is booming, with low unemployment and strong GDP growth. This could lead to an increase in demand for the US dollar, pushing its value higher against other currencies. On the other hand, if there's political turmoil in a country, investors might lose confidence in its currency, causing its value to decline. Forex trading can be incredibly fast-paced and volatile, with prices changing rapidly throughout the day. It's not uncommon for traders to open and close multiple trades within a single day, trying to capitalize on small price movements. This type of short-term trading is known as scalping, and it can be highly risky, especially for beginners. It requires a deep understanding of technical analysis, risk management, and a whole lot of discipline. Another popular Forex trading strategy is day trading, where traders hold positions for a few hours, aiming to profit from intraday price movements. This approach requires less time commitment than scalping, but still demands a solid understanding of market dynamics. Of course, you can also trade Forex over the long term, holding positions for weeks, months, or even years. This strategy is more focused on fundamental analysis, looking at macroeconomic factors that could impact currency values over time. No matter your trading style, remember that Forex is a leveraged market, meaning you can control a large amount of currency with a relatively small deposit. While leverage can amplify your profits, it can also magnify your losses, so it's crucial to use it responsibly. Now, let's talk about the wild world of cryptocurrency, where fortunes are made and lost overnight. It's the digital gold rush of our time, and everyone's trying to get a piece of the action. But before you jump headfirst into the cryptoverse, let's break down the basics. At its core, cryptocurrency is a digital form of money that uses cryptography for security. Unlike traditional currencies, which are controlled by governments and financial institutions, cryptocurrencies operate on decentralized networks called blockchains. Think of a blockchain like a giant public ledger that records every single transaction made with that cryptocurrency. It's transparent, secure, and virtually tamper-proof. Now, there are thousands of cryptocurrencies out there, but some of the most popular ones include Bitcoin, Ethereum, and Binance Coin. Bitcoin was the first cryptocurrency created in 2009, and it remains the largest by market capitalization. Ethereum, on the other hand, is a blockchain platform that allows developers to build decentralized applications, or dApps. It's like the Apple App Store, but for blockchain technology. Binance Coin is the native cryptocurrency of the Binance Exchange, one of the largest crypto exchanges in the world. It's often used to pay trading fees on the platform and can also be used to invest in other cryptocurrencies. Cryptocurrency trading can be incredibly volatile, with prices swinging wildly up and down. It's not uncommon to see double-digit percentage gains or losses in a single day. One of the main drivers of this volatility is the relatively small size of the crypto market compared to traditional markets. Even a small amount of buying or selling pressure can have a significant impact on prices. Another factor contributing to crypto's volatility is the constant influx of news and speculation. A single tweet from Elon Musk can send the price of Dogecoin soaring, while regulatory crackdowns can send the entire market tumbling. If you're thinking about dipping your toes into the crypto waters, it's crucial to understand the risks involved. Don't invest more than you can afford to lose, and be prepared for a wild ride. Before you even think about buying your first Bitcoin, take some time to learn about different trading strategies. Day trading, swing trading, and hodling are just a few of the many approaches you can take. Day trading in the crypto market is like riding a roller coaster blindfolded. You need nerves of steel, lightning-fast reflexes, and a high tolerance for risk. Swing trading is a bit more relaxed, aiming to capture price swings that last for several days or even weeks. And then there's hodling, which basically means buying and holding onto your crypto for dear life, no matter how volatile things get. It's a long-term strategy that requires patience and a strong belief in the future of cryptocurrency. Let's move on to the world of commodities, where you can trade everything from crude oil and gold to coffee and corn. These raw materials form the backbone of the global economy, and their prices can have a ripple effect on everything from the cost of your morning coffee to the price of filling up your gas tank. Commodities are often categorized into two main groups: hard commodities and soft commodities. Hard commodities are typically natural resources that are mined or extracted, such as gold, silver, copper, and crude oil. Soft commodities, on the other hand, are generally agricultural products like coffee, cocoa, sugar, and wheat. Now, imagine for a moment that you're a farmer in the Midwest and you've just harvested a bumper crop of corn. You're sitting on a mountain of golden kernels, but there's just one problem: you can't eat it all yourself. That's where commodity markets come in. They provide a platform for producers like our corn farmer to sell their goods to buyers around the world. And just like any other market, commodity prices are driven by supply and demand. Let's say there's a sudden drought in Brazil, one of the world's largest coffee producers. This could lead to a shortage of coffee beans, pushing up the price of your morning cup of joe. On the other hand, if there's a technological breakthrough that allows oil companies to extract crude oil more efficiently, this could lead to an increase in supply, potentially lowering gasoline prices. Commodities trading can be a complex and volatile endeavor, influenced by a wide range of factors, including weather patterns, geopolitical events, and economic growth. For example, if there's a hurricane in the Gulf of Mexico, it could disrupt oil production, sending crude oil prices soaring. Or if there's a trade war between two major economies, it could disrupt global supply chains, impacting the prices of everything from soybeans to copper. One of the most common ways to trade commodities is through futures contracts. A futures contract is an agreement to buy or sell a specific quantity of a commodity at a predetermined price and date in the future. For example, let's say you're a cereal manufacturer and you need to purchase a large quantity of wheat in 6 months. You could enter into a futures contract to buy wheat at today's price, locking in your cost and protecting yourself from potential price increases. Of course, futures trading can be risky as prices can move against you. If the price of wheat falls below the price you agreed to pay in your futures contract, you're still obligated to buy it at the higher price. Another way to trade commodities is through exchange-traded funds, or ETFs. Commodity ETFs track the price of a particular commodity or basket of commodities, making it easier for investors to gain exposure to this asset class without having to deal with the complexities of futures trading. That's it for our whirlwind tour of the trading world. We've covered a lot of ground today, from the ins and outs of stock trading to the wild world of cryptocurrency. Remember, trading can be a powerful tool to grow your wealth, but it's not without its risks. It's essential to do your research, understand the markets you're trading, and never invest more than you can afford to lose. If you found this video helpful, be sure to give it a thumbs up, subscribe to the channel for more videos like this, and hit the notification bell so you never miss an update. Happy trading!